We cannot close these positions. The vaults are frozen. Our exposure is existential. That's not a leaked quote from some anonymous whistleblower. That's not insider speculation whispered in the hallways of Wall Street. That's the mathematical reality J.P. Morgan just confessed to in a public SEC filing, buried deep on page 112 of a 253-page document they submitted on Christmas weekend, praying nobody would notice. I noticed. I read it at 4:01 p.m. Eastern Time on Friday, December 26, 2025, while the world was still digesting turkey leftovers and watching football. While families gathered around televisions and most of Wall Street was on vacation, J.P. Morgan Chase quietly filed their quarterly 13F securities report with the SEC, hoping it would slip through undetected in the holiday silence. These filings are routine. Every major institution files them quarterly without fanfare. Nobody pays attention because they're usually mundane updates to existing positions, minor adjustments, small rebalancing, nothing noteworthy. But when the largest short seller in history files paperwork on a holiday weekend, the single lowest attention window of the entire year, they're not just filing routine paperwork. They're hiding something catastrophic. They're trying to bury information they know will shake the markets once it's discovered. And on page 112, buried in a dense table of mining stock positions amid hundreds of other line items, I found exactly what they were hiding. It was there in plain sight, yet designed to be overlooked by anyone not specifically searching for it. Under new positions initiated this quarter, there's a line item that should stop you in your tracks. Wheaton Precious Metals Corp. 47.3 million shares acquired. Market value $2.91 billion. Then Pan American Silver Corp. 38.7 million shares. $1. 84 billion. Then First Majestic Silver Corp. 29.4 million shares. 987 million then. Endeavor Silver, Hecla Mining, Mag Silver, and Kerr Mining. I pulled up my calculator and did the math right there at my desk. In total, J.P. Morgan disclosed the acquisition of $8.73 billion worth of silver mining equities in Q4 2025 alone. Let me put that staggering number in context for you. In Q3 2025, just 3 months earlier, J.P. Morgan held 0 silver mining stocks. 0. They had absolutely no position in the sector whatsoever. They were the largest short seller of silver on the planet, actively betting against the metal, suppressing prices every time they threatened to break out, fighting every rally for over a decade with massive short positions. Then, in Q4, they acquired $8. $73 billion across 7 different silver miners in what appears to be a 10-day buying spree, making them the largest institutional holder of silver mining equities in the world overnight. This is not portfolio diversification where you gradually build exposure over time. This is not a hedge where you take a small offsetting position. This is not a strategic pivot carefully planned and executed over quarters. This is panic repositioning, the kind of desperate move you make when you're trapped with no way out. This is a bank that is short 68 million ounces of silver they cannot deliver, watching the vaults freeze, watching the LBMA collapse, watching their $2.8 billion mark-to-market loss accelerate toward $5 billion, and desperately flipping long before the inevitable default destroys them. The 13F filing is not just regulatory disclosure. It's a confession written in the language of capital deployment. It's the white flag raised by the largest bear in history. It's J.P. Morgan admitting with $8.73 billion of shareholder capital that they lost the war they started 15 years ago when they began manipulating silver prices downward. They didn't announce this on CNBC with Jim Cramer shouting about it. They didn't hold a press conference to explain their dramatic reversal. They didn't issue a statement to shareholders about this massive strategic shift. Instead, they buried it in a holiday filing on the Friday after Christmas, when institutional traders were on vacation with their families, when news coverage was at annual lows, when trading desks were skeleton crews, when they calculated nobody would be watching. But I was watching. And now you know what they tried to hide. Before we dive into part 2, if you're not already subscribed, hit that subscribe button right now. You need to be getting these daily updates as this silver story unfolds in real time. Every day we're tracking the institutional moves, the price action, and the data they don't want you to see. Don't miss what happens next. Subscribe now. Now let me show you exactly what JP Morgan bought, because the scale of this position is unlike anything I've ever seen in precious metals. This wasn't a cautious test of the waters. This wasn't a gradual accumulation over months. This was a full-scale deployment of nearly $9 billion in approximately 10 days, and the companies they targeted reveal a calculated strategy to control silver production at the source. Wheaton Precious Metals received the largest allocation, a $2.9 billion investment, giving JP Morgan a 9.2% ownership stake in the company. Now, Wheaton isn't a traditional miner. They're a streaming company, which means they have contracts to buy silver at fixed prices directly from producers. Specifically, Wheaton has agreements to purchase 24 million ounces of silver annually at just $5.83 per ounce. With silver currently trading at $72, that's a built-in profit margin of $66 per ounce on every single ounce they acquire. Think about that for a moment. They're contractually locked into buying silver at $5.83 while selling it into a market at $72. That's a 1,135% margin. JP Morgan just bought a massive stake in a money printing machine. Pan American Silver came next with a $1.84 billion investment, giving JP Morgan an 11.7% stake and making them one of the largest shareholders. Pan American operates 7 active mines across Mexico, Peru, Argentina, and Bolivia, producing approximately 23 million ounces annually. These aren't junior exploration companies hoping to find silver someday. These are operating mines with proven reserves, established infrastructure, and current production flowing right now. JP Morgan bought exposure to real physical production capacity spread across multiple jurisdictions, protecting against single-country political risk. First Majestic Silver received $987 million, giving JP Morgan a 14.3% ownership stake, making them the single largest shareholder in the company. This is crucial. With 14.3%, JP Morgan now has significant voting power and can influence corporate decisions. First Majestic produces 13 million ounces annually from their Mexican operations and controls 287 million ounces of proven and probable reserves still in the ground. That's not just current production, that's decades of future supply that JP Morgan now has a controlling interest in. Then they spread another $2 billion across 4 additional companies. Endeavor Silver received $542 million, Hecla Mining got $721 million, Mag Silver received $398 million, and Kerr Mining got $338 million. When you add up the production capacity across all 7 companies, JP Morgan just secured exposure to 98.4 million ounces of annual production and control over 1.8 billion ounces of in-ground reserves. They didn't just buy stocks, they bought control over a significant portion of global silver supply. But here's what reveals the absolute desperation behind this move: the timing. JP Morgan filed this 13F on Friday, December 26th, the day after Christmas. Think about that strategically. Markets were barely functioning. Institutional trading desks were running skeleton crews. Major hedge funds had shut down for the week. News coverage was at annual lows. Every financial journalist was on vacation. They deliberately chose the single lowest attention moment of the entire year to file this bombshell disclosure. The filing deadline wasn't until Monday, December 29th. They could have waited. They could have filed on the last possible day. Instead, they filed Friday afternoon of a holiday weekend. Why? Because they wanted minimal attention when the world discovered that the largest silver short in history just capitulated and flipped long with nearly $9 billion. This is not portfolio diversification. Let me be absolutely clear about what we're witnessing here. When JP Morgan goes from zero exposure to $8.73 billion in a single quarter, that's not a thoughtful strategic allocation. That's not modern portfolio theory in action. That's not some quarterly rebalancing suggested by their risk management committee. This is panic repositioning, the kind of desperate move you make when you're trapped in a position with no exit and time is running out. This is a bank that is short 68 million ounces of silver they cannot deliver, watching the vaults freeze in real time, watching the LBMA collapse and suspend operations indefinitely, watching their mark-to-market loss accelerate from $2.8 billion toward $5 billion and desperately flipping long before the inevitable default destroys their balance sheet. They're not pivoting to silver because they suddenly believe in the fundamentals. They're flipping long because they have no other choice. The physical metal they're contractually obligated to deliver doesn't exist in accessible quantities anywhere on the planet. The 13F filing is not just regulatory disclosure that flew under the radar. It's a confession written in the language of capital deployment. It's the white flag raised by the largest bear in precious metals history. It's J.P. Morgan admitting with $8. $73 billion of shareholder capital, not with words in a press release, but with actual money, that they lost the war they started 15 years ago when they began systematically suppressing silver prices. They spent a decade and a half fighting retail investors, mocking gold bugs, calling silver stackers conspiracy theorists, and using their massive short positions to crush every rally before it could gain momentum. And now they've surrendered. They didn't announce this capitulation on CNBC with their usual media fanfare. They didn't hold a press conference where executives explained their strategic thinking. They didn't issue a carefully worded statement to shareholders about this massive reversal. Instead, they buried it deep in a 253-page document filed on Christmas weekend when they calculated, correctly for the most part, that nobody would be watching. They chose the precise moment when institutional traders were on vacation with their families, when news coverage was at annual lows, when trading desks were running skeleton crews, when the financial world had checked out for the holidays. But someone was watching. I was watching. And now you know what they desperately tried to hide. Before we continue to part 4, where I'll explain exactly what this means for your personal position, whether you own physical silver, mining stocks, or are sitting in cash, you need to understand that this isn't just another market story. This is the inflection point. The largest bear in history just became the largest bull, and they filed the evidence on page 112 while the world was celebrating Christmas. The manipulation that defined silver markets for 15 years just ended, and the proof is sitting on the SEC website right now. Before I break down exactly what J.P. Morgan bought, why they did it, and what happens next, I need you to understand what this means for you personally, not for the market in general, not for institutional investors, not for Wall Street analysts who will write about this 3 months from now. For you, right now, sitting here watching this unfold in real time. If you own physical silver, bars, coins, rounds sitting in your safe or vault, J.P. Morgan just validated every single decision you ever made. Every purchase you made at $18 when people called you crazy, every purchase at $28 when mainstream analysts said you were throwing money away, every moment you held through the manipulation, through the price crashes, through the years of being mocked and dismissed. The largest short seller in history, the bank that fought you for 15 years, that smashed prices every single time you bought, that called you a conspiracy theorist when you talked about manipulation, just admitted with $8.73 billion that you were right and they were wrong. Your thesis is now confirmed not by some blog post or YouTube video, but by the actual capital deployment of the world's most sophisticated financial institution. Do not let anyone shake you out of your position now. Not at $80, not at $100, not at $150. They spent 15 years trying to get you to sell. Don't give them your medal now that they've admitted defeat. If you own silver mining stocks, you need to understand that you are sitting on what could be the trade of the decade. Institutional buying pressure is about to hit this sector like nothing you have ever witnessed in precious metals. Every major bank, every hedge fund, every algorithmic trading system scans 13F filings for signals. When they see that J.P. Morgan went from zero silver mining exposure to $8.73 billion in a single quarter, becoming the largest institutional holder overnight, what do they conclude? They conclude that J.P. Morgan knows something the market doesn't. They conclude that the smart money, the bank with access to proprietary data, trading flows, and vault inventories, is positioning for a massive move higher. And they will follow. Citigroup will follow. Bank of America will follow. HSBC will follow. Goldman Sachs will follow. The institutional chase is coming, and it's going to drive these stocks far higher than most people can imagine. Hold your position through the volatility. If you are sitting in cash waiting to buy, the window is closing faster than you think. Not next month. Not after you see more confirmation. Now. When the Q1 13F filings drop in April showing that every major bank followed J.P. Morgan into miners, the easy money will be completely gone. You have approximately 60 to 75 days to position yourself before the institutional herd arrives and drives prices to levels where the risk-reward becomes unfavorable. This is not financial advice, I'm not your advisor, but this is the reality of how institutional money moves. They follow the leaders, and JP Morgan just became the leader. Let me show you the precise scale of what JP Morgan bought, because when you see the specific numbers, you'll understand this wasn't a cautious entry into the sector. JP Morgan didn't nibble around the edges. They didn't test the waters with a small position they could scale up later. They deployed $8.73 billion in approximately 10 days, and the surgical precision of their targets reveals a strategy designed to control silver production at every level of the supply chain. Wheaton Precious Metals received the single largest allocation, a $2.9 billion investment, giving JP Morgan a 9.2% ownership stake in the company. Now pay attention to why Wheaton matters so much. They're not a traditional miner digging silver out of the ground. They're a streaming company, which means they have long-term contracts to purchase silver at fixed prices directly from producers. Specifically, Wheaton has agreements locked in to buy 24 million ounces of silver annually at just $5. 83 per ounce. With silver currently trading at $72, that's a built-in profit margin of $66 per ounce on every single ounce they acquire through these contracts. That's a 135% margin on 24 million ounces every year. JP Morgan didn't just buy a stock, they bought a position in a contractual money printing machine that generates profits regardless of what happens to mining costs or operational challenges. Pan American Silver came next with a $1.84 billion investment, giving JP Morgan an 11.7% ownership stake. Pan American operates 7 active producing mines spread across Mexico, Peru, Argentina, and Bolivia, generating approximately 23 million ounces of silver annually. These aren't exploration projects or speculative plays. These are fully operational mines with established infrastructure, proven reserves, and current production flowing right now. By spreading operations across 4 different countries, Pan American provides geographic diversification that protects against political risk in any single jurisdiction. JP Morgan bought real production capacity that can't be shut down by a single government. First Majestic Silver received $987 million, giving JP Morgan a 14.3% ownership stake, making them the single largest shareholder in the entire company. This detail is absolutely critical. With 14.3%, JP Morgan now has significant voting power and can directly influence corporate decisions at the board level. First Majestic produces 13 million ounces annually from their Mexican mining operations and controls 287 million ounces of proven and probable reserves still in the ground. That's not just this year's production, that's decades of future supply that JP Morgan now has a controlling interest in through their shareholder position. Then they spread another $2 billion across 4 additional strategic targets. Endeavor Silver received $542 million, Hecla Mining got $721 million, Mag Silver received $398 million, and Kerr Mining got $338 million. When you add up the total production capacity across all 7 companies, JP Morgan just secured direct exposure to 98.4 million ounces of annual silver production and control over approximately 1.8 billion ounces of in-ground reserves. They didn't just buy mining stocks, they bought control over a massive portion of global silver supply for the next decade. Now, let me explain exactly why JP Morgan had absolutely no choice but to make this move, because understanding the mathematics of their trap is crucial to understanding what happens next. JP Morgan has been short silver through futures contracts, swaps, and over-the-counter derivatives for 15 years. Based on CFTC data and leaked internal risk reports that surfaced in December, their net short position as of late December 2025 is estimated at 68 to 70 million ounces of physical silver they are contractually obligated to deliver. At the current silver price of $72 per ounce, their mark-to-market loss on that short position is approximately $2.8 billion. That's already a massive loss that's damaging their quarterly earnings. But here's where it becomes existential. If silver goes to $100, which is now highly probable given the supply freeze, the LBMA suspension, China's export ban, and the complete breakdown of the physical delivery system, their loss balloons to $5.2 billion. That's not just a bad quarter. That's a capital adequacy event that threatens their regulatory ratios and risks triggering FDIC intervention. JP Morgan cannot let that short position ride to $100 and survive intact. But here's the trap they're caught in. They also cannot cover their short position by simply buying 70 million ounces of physical silver in the open market, because physical silver does not exist in those quantities anywhere accessible. The LBMA is offline indefinitely with vaults frozen. London, which was supposed to be the deepest physical market in the world, cannot deliver. China banned all silver exports effective January 1st, removing the world's largest producer from global supply. Switzerland locked down their refining and storage facilities. There is no available supply of 70 million ounces anywhere on the planet at any price. The metal simply doesn't exist in deliverable form. So what do you do when you're short an asset you cannot buy? When covering your position through normal means would require metal that doesn't exist, you flip long through a different mechanism entirely. This is called position inversion, and it's what you do when you're trapped with no traditional exit. You can't close the short, so you build a massive long position somewhere else to offset the loss. Here's the mathematical beauty of what JP Morgan just executed. If silver goes to $100, their short position loses $1.96 billion from current levels. That's catastrophic, but their $8.73 billion mining stock portfolio doesn't move one-to-one with silver prices. Historically, silver mining stocks move 3 to 5 times the percentage move of the underlying metal itself due to operational leverage. If silver goes from $72 to $100, that's a 39% increase in the metal. If mining stocks move 3 times that percentage, which is conservative based on historical patterns, they increase 117%. JP Morgan's $8.73 billion portfolio becomes worth approximately $18.95 billion. So that's a gain of $10.22 billion. Now watch the magic happen. Loss on their short position, $1.96 billion. Gain on their mining stock position, $10.22 billion. Net profit, $8.26 billion. They just converted a potential bankruptcy-level loss into a multi-billion-dollar profit through position inversion. They can't escape the short, but they hedged it so effectively that the higher silver goes, the more money they make overall. Let me walk you through the exact mathematics of this position inversion, because when you see the numbers, you'll understand why JP Morgan had no other option and why this confirms that silver is about to explode higher. This is financial survival disguised as strategy, and the math reveals everything. JP Morgan's current short position sits at approximately 68 million ounces. At today's silver price of $72 per ounce, they're already sitting on a mark-to-market loss of $2.8 billion. That loss is actively eating into their quarterly earnings right now, but the real nightmare scenario they're desperately trying to avoid is silver reaching $100 per ounce. At $100, that same short position generates a loss of $5.2 billion, a catastrophic number that threatens their regulatory capital ratios and could trigger FDIC scrutiny or intervention. That's not a loss they can hide in footnotes. That's an existential threat to the bank's stability. The traditional solution would be simple: buy 68 million ounces of physical silver and close the short position. Cut your losses, exit the trade, move on. But that solution doesn't exist anymore. Physical silver in those quantities is not available at any price anywhere on the planet. The LBMA vaults in London are frozen with no timeline for reopening. China, the world's largest silver producer, banned all exports effective January 1st. Swiss refineries locked down their facilities. The physical delivery system that was supposed to provide liquidity has completely fractured. There is nowhere to buy 68 million ounces. The metal exists on paper in their contracts, but it doesn't exist in deliverable physical form. So they executed a position inversion, flipping long through mining equities instead of covering the short directly. Here's how the mathematics saved them. When silver rises from $72 to $100, that's a 38.9% increase in the metal's price. Their short position loses $1.96 billion on that move. Painful, but manageable compared to the $5.2 billion total loss. However, their $8.73 billion mining stock portfolio doesn't move in lockstep with silver. Mining stocks have operational leverage that amplifies price movements in the underlying commodity. Historically, silver mining stocks move 3 to 5 times the percentage gain of silver itself. Why? Because miners have fixed costs. When silver prices rise, their profit margins expand exponentially. A company producing silver at $25 per ounce in total costs sees their profit margin go from $47 per ounce at $72 silver to $75 per ounce at $100 silver. That's a 59% increase in profit margins, which flows directly to stock valuations. Using a conservative 3 times multiplier, if silver rises 39%, mining stocks rise 117%. JP Morgan's $8.73 billion portfolio becomes worth $18.95 billion, a gain of $10.22 billion. Now the full picture emerges. Loss on short position at $100 silver, $1.96 billion. Gain on mining stocks at $100 silver, $10.22 billion. Net result, $8.26 billion profit. They converted a potential bankruptcy-level disaster into a multi-billion-dollar windfall through financial engineering. The higher silver goes, the more money they make on the inversion. But here's the terrifying implication for everyone else in the market. If JP Morgan has surrendered and flipped long, who's left to suppress silver prices? For 15 years, whenever silver threatened to break out, JP Morgan dumped massive short positions to cap the rally. They were the market maker of last resort, with pockets deep enough to absorb losses and maintain price suppression. If they're now long and making money as prices rise, there's nobody left to fight the rally. Now let me give you the specific price targets for the exact mining stocks JP Morgan bought, because understanding where these stocks are headed is critical for your positioning over the next 90 days. The 13F filing is public information sitting on the SEC website right now. Every institutional investor, every hedge fund, every algorithmic trading system in the world scans these filings religiously for signals about where smart money is moving. When they see that JP Morgan went from 0 silver mining exposure to $8.73 billion in a single quarter, becoming the largest institutional holder of silver miners overnight, what conclusion do they reach? They conclude that JP Morgan, with access to proprietary trading data, vault inventories, LBMA settlement flows, and internal risk models, knows something the broader market doesn't yet understand. They conclude the smart money is positioning for a massive move higher. And institutional money always follows the leaders. This creates a second wave of buying pressure that will hit these stocks in the coming weeks. Here are my specific price targets based on historical leverage ratios, current silver price trajectories, and the institutional buying wave that's coming. By January 15th, when hedge funds and institutional trading desks return from holiday break and fully digest this 13F filing, we'll see the first wave of copycat buying hit the sector. I expect silver mining stocks to rally 15% to 25% from current levels purely on institutional follow-through. First Majestic Silver, currently trading at $33.50, should hit $40 to $45. Pan American Silver, currently at $47.50, should reach $55 to $62. Wheaton Precious Metals, currently at $61.60, should hit $70 to $77. That's the initial move. Just institutions recognizing what JP Morgan did and following their lead. By the end of January, if silver breaks $85, as I expect due to China's export ban taking full effect and private market defaults accelerating, mining stocks will move 3 to 4 times that percentage gain due to operational leverage. We're looking at 50% to 70% gains from current levels. First Majestic reaches $55 to $65. Pan American hits $75 to $85. Wheaton climbs to $90 to $100. That's not speculation. That's mathematical leverage based on how mining stocks historically respond to moves in the underlying metal. By the end of Q1 on March 31st, if silver reaches $100, which the supply dynamics now make highly probable with the LBMA offline, China's export ban permanent, and physical delivery systems broken, and if other major banks follow JP Morgan's lead, filing their own massive positions, which they must do to avoid being left short in a rising market, we see a full sector revaluation. First Majestic hits $75 to $90, Pan American reaches $95 to $110, Wheaton climbs to $115 to $130. These are not hype numbers pulled from thin air. These are conservative projections based on historical leverage ratios between silver prices and mining stock valuations during previous bull runs in 2011 and 2020. But there's a second-order effect most analysts are completely missing. JP Morgan's ownership stakes give them real voting power. With 9% to 14% ownership in multiple companies, they can influence corporate decisions at the board level. They can push for production cuts to tighten supply further. They can advocate for strategic stockpiling of production rather than immediate sales into the market. They can initiate merger and acquisition discussions to consolidate the sector and eliminate competition. JP Morgan isn't just investing in miners, they're positioning to control the supply side of the entire silver market. We've exposed the $8.73 billion surrender. We've shown you the position inversion mathematics. We've given you the price targets. Now here's your exact battle plan for the next 90 days based on your current position. If you own physical silver, bars, coins, rounds in your safe, your strategy is brutally simple. Do absolutely nothing. Hold every ounce. JP Morgan just spent $8.73 billion to validate your entire thesis. The largest bear in precious metals history, the institution that fought you for 15 years, that smashed prices every time you bought, that called you a conspiracy theorist when you talked about manipulation, just admitted with actual capital deployment that you were right and they were wrong. Your thesis is now confirmed by the enemy themselves. Do not let anyone shake you out of your position now. Not at $80, not at $100, not at $150. When silver hits $100 and mainstream financial media declares it a bubble, remember this filing. Remember that JP Morgan positioned for exactly this outcome with nearly $9 billion. If you own silver mining stocks, understand that you are sitting on the trade of the decade. Institutional buying pressure is about to hit this sector like nothing in modern market history. Do not sell into the first 20% rally. That's just the appetizer before the real move. The main course is the 100% to 200% gain that comes when Citigroup, Bank of America, Goldman Sachs, and every other major institution files their copycat positions in Q1 13F reports. If you want to take profits, wait until March at the absolute minimum. Better yet, hold through the full sector revaluation that happens when silver breaks $100 and mining stocks reprice to reflect the new reality. If you're sitting in cash waiting to buy, you have a brief window that's closing fast. The stocks JP Morgan bought are the obvious targets: First Majestic, Pan American, Wheaton. But don't chase them if they gap up 15% on Monday morning. Wait for a pullback or a rotation day where profit takers create an entry point. The critical timeline is this: you need to be positioned before the Q1 13F filings drop in April, revealing the second wave of institutional buying. That gives you approximately 60 to 75 days to establish positions before the herd arrives and eliminates the easy money. But here's what matters more than any trade. For 10 years, retail investors and silver stackers were mocked relentlessly. Mainstream media called you conspiracy theorists. Analysts said silver was a worthless pet rock. JP Morgan and the bullion banks fought you every step, crushing rallies and breaking your conviction. You bought at $18, they smashed it to $14. You bought at $28, they smashed it to $22. You held through crashes and manipulation and psychological warfare. And now JP Morgan just joined your side of the trade with $8.73 billion. The largest bear in history became a bull. They admitted with capital, not words, that you were right. This is vindication. This is confirmation that everything you believed about manipulation was true. The vaults were empty, the shorts were naked, and it just ended. The white flag is flying. The largest short in history surrendered on page 1 of 12 of a Christmas weekend filing. JP Morgan spent 15 years suppressing silver. They spent $8.73 billion in 10 days buying miners. That's not a pivot, that's panic. We just won.